10 years since the new normal, 5 years since the new neutral. Joachim, I guess the first question is what's new this morning and with this outlook?
Well, look, John, I think what's new is that we are seeing the end of an era. The last 5 to 10 years, we had massive outperformance of financial assets over the real economy. And we think that era is coming to an end. And we think that we are now entering an age of disruption. There are several secular forces that we think will disrupt the global economy, financial markets, investors' portfolios over the next 3 to 5 years, which is our secular horizon. And we think investors need to get prepared for this. This is why the title of our outlook is Dealing with Disruption.
So we're going to talk about the 5 disruptors in just a moment. Scott, what I think is interesting, just going on the last 5 to 10 years, you guys underline this in the piece. It would be a mistake to extrapolate forward the benign macro market environment of the last 5 to 10 years and push that out in a forecast for, say, the next 3 to 5 years. Why is that such a big mistake this time around?
Well, it seems like markets have become used to an environment where central banks are really powerful in terms of taking the volatility out of the market and pumping asset prices up. And one of the things we talk about in the secular outlook is that, that area is coming to an end. I mean, the U.S. is about the only central bank that was able to normalize policy rates, but elsewhere there's basically no monetary firepower left. And so it's a very different environment for financial market investors. At the same time, everywhere we've seen weakness in the global growth outlook. We still think that people are probably too optimistic about the growth outlook in the U.S., and I think that's what you're seeing in markets now. People starting to come to a more realistic outlook about both the forward-looking growth prospects as well as the power of central banks to pump up asset prices.
Well, let's talk about the forward-looking growth prospects. In this piece, you are assuming a slight mild recession in the United States. Joachim, walk me through that base case for the team at PIMCO.
Yeah, well, first of all, our base case for the average of the next 5 years is we see a continuation of lackluster growth, low inflation, and low new neutral interest rates. But within that period, at some stage, we think there will be a recession. Now, what kind of recession? Well, we think it will be relatively shallow. Why is that? Well, it's because we don't see major imbalances in the real economy at the moment. But we also think the following recovery could be very sluggish because central banks do not have many tools left in their toolkit, and fiscal policy may be late to respond. So it's going to be more of a garden variety recession, but again, it could be somewhat longer, and the following recovery could be more shallow.
You know, as I work through these disruptors that are in the epicenter of the piece you guys have put out this morning, number 5 is market vulnerabilities. And Scott, I want to talk to you about that. The recession might be mild, but the market action, the price action, could be anything but. Your thoughts on that?
Well, a few different things. One, as I mentioned before, there's no hedge to risky assets other than U.S. high-quality bonds, treasuries. And that's a very different starting place than we were at in the last recession, where there was lots of places to look for protection or negatively correlated asset to risky assets. So that's one thing. I mean, the other thing is we have probably the riskiest credit market that we've ever had. And, it's true when you look at both the size of it, the duration of it, and the quality aspects of it. So there's a big vulnerability there, as well as probably the least liquid, bond market in terms of credit markets that we've had in a long period of time. So that's a major vulnerability as well.